For deferring income, sometimes in your business, you might have received the payment in advance, even before you offer the goods or services to your customer, to your clients. So in that sense, these are some of the things that you want to look at and see whether there is a probability to defer the income. Are you on accrual basis or cash basis? If you are on accrual basis, there might be a chance for you to do so and achieve the best tax outcome. And the second thing is, have you derived the income? And to take a closer look in what is deriving income, under normal circumstances, we say that we derive an income when the invoice is being issued to your client. But here are the exceptions. First one, do you need to take further steps to be entitled for the payment? Does it have to be repaid under certain circumstances? And to better illustrate this, I'll walk you through an example. Is Mr. Smith again. So Mr. Smith, he is in a business of giving dancing lessons. He received the payment for 10 tuition courses in advance. So let's say that's one package. So he has got 10 tuition courses over there. And that's 10 courses times $200 per lesson. And that gives him $2,000. And he received the upfront amount in June 2021, which is the last month of the 2021 financial year. He is also subject to a refund if any of the lessons were being cancelled. And assuming that Mr. Smith has other income and is in the tax bracket of 32.5%, and let's look at this example in two different situations. One is cash basis and the other is accrual basis. So on cash basis, what Mr. Smith will do in the tax return is he will be taking the whole package of $2,000 as his assessable income, and he got to pay for the tax for $650. And from there, his cash on hand, whatever will be left for his cash is $1,350. On the other side, if it is on accrual basis, his assessable income is actually only the $200. And the other deferred income is then $1,800. And this is on the assumption that Mr. Smith has only conducted one tuition lesson. So here we have 10 lessons, but he only conducted one. So that makes the assessable income $200. After paying for the tax for the one lesson, he will have the cash on hand of $1,935. And as you can see, Mr. Smith, he has got a better tax outcomes under this method, which he tried to defer the income to the next financial year because the income was not derived. So that's all what we wanted to talk about today. And just a quick recap, we have home office expense. We talk about home office expense. We talk about the two methods under home office expense, which is we have our shortcut method and we have our fixed rate method. And then moving on, we also talk about prepayment expense, bringing forward expense. What are the things that you want to consider before trying to bring forward expense? And we're also looking at the other side of the equation, which is deferring income. Have you derived the income? What can you do to make sure that you can derive for the income?